ready to get started when you are.
Thank you, Ashley. Good morning, everyone. This meeting of the board is a hybrid physical virtual meeting. I'd like to welcome those in the boardroom with me today and those joining virtually. While keeping your microphone muted, please join me in the Pledge of Allegiance. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice. Before we get started, just want to take a moment to recognize our 250th anniversary of the signing of the Declaration of Independence. I know it was last week, but it feels like it's worthy of more than just a day of celebration. 250 years ago, our founders set forth the bold ideas of a nation built on the principles of liberty, justice, and self-governance. It's an idea that has endured through generations due to the individual efforts of citizens across our great nation to preserve our freedoms and strengthen our public institutions. We as public servants have the privilege and responsibilities of carrying out that work forward, and we do so by ensuring that our nation's farmers, ranchers, and rural communities have access to safe, sound, and affordable source of credit. Our work in support of American agriculture contributes to the strength and prosperity of our nation. As we commemorate this historic milestone, I hope everyone will take this opportunity to reflect on our nation's founding principles, the countless patriots and heroes who came before us. Let us never take for granted our shared responsibility and to build an even better tomorrow for the generations to follow. And at this time, I'll ask the Secretary to the Board to address a few technical and protocol items.
We have a quorum. The full board is present for this meeting. Chairman Hall and Board Member Smith. Please ensure that you have silenced any mobile devices you have with you. The virtual portion of this hybrid meeting is on Cisco WebEx. We have two OIT staff, Ben Rana and Victor Amaya, monitoring and managing the meeting. They will be locking this meeting and no new connections will be allowed. OIT will be advancing the slides, so you will hear presenters say, "Next slide." If you lose connectivity in this meeting, please contact Victor Amaya. Lastly, this meeting is being recorded. The video recording of the open portion of this meeting will be posted for public viewing for a limited period of time. Chairman Hall, that concludes the technical and protocol items. We're ready to continue when you are.
Thank you, Ashley. The Secretary will now read an opening statement on the Government and the Sunshine Act.
This is an open Farm Credit Administration Board meeting under the Government and the Sunshine Act. If anyone raises a subject that may be discussed in closed session as permitted by the Government and the Sunshine Act, Chairman Hall will entertain a motion to close the meeting.
Now we'll review the published meeting agenda. Is there a motion to adopt the agenda as published?
There is, Mr. Chairman. I move to adopt the agenda as published.
I second the motion. The motion has been made and seconded. Any further discussion? If not, the Secretary will record the vote on this motion.
Mr. Smith?
Aye.
Chairman Hall?
Aye. Motion carries. Next, we will consider whether any portions of the meeting should be closed to the public.
The agenda does not include items that we should properly discuss in closed session. I move that the entire meeting remain open.
And I second the motion. The motion has been made and seconded. Any further discussion? If not, the Secretary will record the vote on the motion.
Mr. Smith?
Aye.
Chairman Hall?
Aye. Motion carries. Please turn to tab 1, and this next item is the approval of the minutes as presented behind tab 1.
I move to approve the minutes for the June 11th, 2026 regular board meeting as presented.
I second the motion. Motion has been made and seconded. Any further discussion? If not, the Secretary will record the vote on the motion.
Mr. Smith?
Aye.
Chairman Hall?
Aye. Motion carries. Please turn to tab 2. And at this time, I'll ask Yara Pollard to present the update on the Farm Credit System funding conditions. This will be an information item.
Good morning, Chairman Hall and Board Member Smith. My name is Shara Pollard. I'm a Senior Policy Analyst with the Finance and Capital Markets team in the Office of Regulatory Policy. Thank you for the opportunity to provide an update on the Farm Credit System's funding conditions. One of FCA's responsibilities under the Farm Credit Act is to approve system funding requests. And adjacent to that role is the monitoring and reporting on funding conditions, which brings me to my prepared remarks. Next slide, please. And we can go to the next slide, please. So I wanted to start just by talking about a few headlines that have been in the news recently. First of all, inflation. So this has been front and center in the bond market news in recent months as inflation metrics continue to put upward pressure or to point to upward pressure. And these pressures have intensified since the US-Iran conflict. The headline Personal Consumption Expenditures Index, or PCE for short, which includes both food and energy, has moved from 2.7% year over year in October, which is when we had our last funding update, to 4.1% in May of this year. And I will note that the number in the headline is CPI, which is why the number is a little bit different. And looking at core PCE, which is the Fed's preferred metric for inflation, that's moved from 2.8 to 3.4.1% over the same time period. The Fed did make two rate cuts late last year, and this was based on downside risks to employment. However, they left rates steady during their June meeting, and this is largely due to persistent inflation. And I'll talk more about the Fed a little bit later in the presentation. Next slide, please. So the other thing I wanted to touch on is the US's reliance more on short-term debt issuance, given the term premium on longer-term issuance. And as of right now, there's still the capacity to soak up the issuance. However, there could be a point at which that capacity will be challenged. T-bills as a share of total outstanding federal debt is right around 22% right now. And it's only been 25% or more during financial crises and recessions. So just something that we're monitoring. And that increased T-bill issuance, it could impact system pricing at some point, given that T-bills compete with system debt for investors. And that's something that we've already seen a little bit of that impact, which I'll touch on later. And then there's also the possibility that, I've seen a bit of in the news of a continued rotation out of U.S. treasuries by foreign investors as the U.S.'s fiscal position becomes more strained and yields become more attractive elsewhere. But I'll talk about that a little bit later on a future slide. Next slide, please. So this slide just outlines the topics that I'll be touching on this morning. I'm going to talk about global markets and then look at the agency debt market specifically, farm credit system funding activity, as well as pricing and yields. I'll also talk about secondary liquidity, which for the system means their ability to fund maturing obligations when they're unable to issue debt. And this is done through their investment portfolios. And then I'll just talk a little bit about the implications of ongoing geopolitical conflicts. Next slide, please. So in terms of the US market, I've talked a bit about inflation. And as a reminder, the Fed has their dual mandate, full employment and price stability. So inflation remains above the 2% target. But in terms of the employment and the labor market does continue to be resilient. There have been recent signs of what I'd call stabilization. So we've had 3 months of strong, albeit a little uneven job growth that's been driven largely by healthcare. And then we had the June jobs number come in well below expectations. So we'll see if that's the beginning of a trend or just a data point. The unemployment rate is 4.2%, so that indicates relative health. As the labor market seems to be in what's described as a low hire, low fire state. So there's cautious hiring, but on the flip side, we haven't seen a lot of widespread layoffs. The economy continues to grow, but there are some signs of softness. So first quarter GDP was 2.1% versus 0.5% at the end of the year for the fourth quarter. So business investment increased. We've seen exports increase as well as government spending. And consumer spending continues to be robust. There are some signs of potential weakening, so that's just something to monitor given that consumer spending is the growth of, is the engine of GDP growth. And then just looking at what's happening elsewhere in the world. So the European Central Bank, they kept rates steady at 2% between October, which was our last presentation, until last month. And then they did decide to raise rates by 25 basis points. So they're now at 2.25%. And this was following, again, inflation concerns and higher energy prices. Their inflation did fall more than expected in June, so the urgency for another white hike has somewhat subsided, but that's a fluid situation. And then the Bank of England, they were facing some weaknesses in the UK economy, so they were actually cutting rates, but they decided to keep them steady at the most recent meeting, again, due to inflation. And then the Bank of Japan, they hiked rates by 50 basis points over the last 6 months. So they had two 25 basis point hikes, and they're right around 1%. And this, again, was largely due to concerns over inflation. And then we have China, which obviously is another large economy. They continue to face challenges in their consumer demand, as well as their property sector is quite troubled. So the central bank, they've kept rates steady, but they have been injecting liquidity into their markets to remain accommodative. And we're not seeing a lot of material risks to the US Treasury and GSE markets based on what's happening in these other geographies. Again, I mentioned there might be some reallocation of holdings based on the relative attractiveness of different sovereign debts. For example, there was news of Japanese asset managers reallocating away from treasuries into Japanese bonds, given the relative attractiveness of Japanese government bonds. However, that hasn't clearly materialized, and I think things are almost moving in the other direction in more recent weeks. So again, that's something that we monitor, but we haven't seen any sort of significant trends there. And in terms of geopolitical impacts, I talked about military conflicts during our last update, so Ukraine and the Middle East, as well as trade wars. Since then, the US-Iran conflict has really taken center stage, and that the key impact there has been inflationary pressure, which can put upward pressure on US treasuries and therefore system yields. Next slide, please. So this slide, it shows the trend in 10-year yields. So we're looking out further on the yield curve for major economies around the world, and we're looking back 2 years. So it's June 2024 to June 2026. And you'll see on the right-hand side of the screen that yields have continued to move up in recent months. And this is partly due to investor concern over the ability of these governments to support higher debt levels. But it's also due to the inflationary pressures that we've talked about. So when I mentioned that the potential allocation out of US treasuries into other sovereigns, I mean, a lot of these other countries are facing similar challenges as the US is. Next slide, please. So this slide outlines the credit ratings for the United States. As a reminder, system debt ratings are linked to that of the US government. There haven't been any changes since our last funding update in October. Just as a reminder, Moody's did downgrade the US debt from AAA to AA1 back in May of 2025. And this was due to concerns over the level of debt and the ability to service that debt. That downgrade didn't have an impact to the system in terms of access or spreads. And again, there haven't been any changes since then. Next slide, please. So looking now at the agency markets. So system issuance for 2025, you'll notice that we rank third. We were sort of the system was in second place. And then in 2025, Fannie Mae, their issuance increased. And this was partly because of increases in their mortgage-backed security portfolio and also increases in their multifamily financing activities. So as their balance sheet expanded, they had more issuance. The other thing I wanted to point out, year to date, 2026, the system looks to be on track to be well above 2025 levels. However, that number is largely due to a spike in discount note issuance that has since declined. Discount notes are short term, so they roll over, which can sort of inflate the issuance numbers. And then you'll notice that I talked about about Fannie there. Their issuance has also been somewhat elevated the first 3 months, and that's related to the mortgage bond portfolio increase. If you recall, President Trump had a directive for $200 billion in mortgage bond purchases, and this is an attempt to lower mortgage rates. So that's what we're seeing there. Next slide, please. In terms of debt outstanding, not a lot has changed here. The system is still second to the Federal Home Loan Banks, and the system is right around 23% of the total GSE market. And the system's debt continues to be well received, given its mission and consistent financial results. Next slide, please. So looking in a little more detail at system debt issuance, this shows debt issuance by the type of debt. So during my last funding update, we talked about the rotation from discount notes into floating rate notes between 2022 and 2023. And this related to an increase in interest rates because investors prefer to be in floating rate debt when rates are rising, as well as various other factors. There were some SEC rule changes that made money market funds more attractive. And so that sort of explains that move. And that demand has continued in terms of that support for SOFR floating rate debt. And the other thing I wanted to point out is that in 2025, the system saw callable debt issuance increase as a portion of total issuance. And that was in reaction to, as rates declined, more debt was called, and that debt had to be replaced. That trend has slowed down a bit year to date as rates have stayed steady. So the system isn't seeing as much debt being called. Next slide, please. So this slide shows the FCS debt outstanding, and you can see not a whole lot has changed since the end of last year. The SOFR floating rate notes are there in the purple, and they're still sort of the bulk of total debt outstanding. The main story here continues to be that rotation into SOFR. But I will say that demand for the other types of debt remains robust. Next slide, please. This slide lists out the 33 dealer group members who underwrite and distribute system debt. There haven't been any changes since my last funding update. I will say that the system debt continues to be held by a broad group of investors, and that's thanks to the capabilities of both the dealers and the funding corp's ability to effectively manage the dealer relationships. Next slide, please. So for the last couple of years, we've presented this slide and we've had an inverted yield curve, and now we've finally moved into a situation where the yield curve is more normal. It's still somewhat flat in the middle of the curve, but it's a relatively normal shape. And if you recall, I talked during my last presentation about the financial institutions. They tend to borrow on the short term of the curve and land on the long end. So when you have that inverted yield curve, that can be challenging from a spread perspective. So a return to a more normal yield curve is a positive in that sense. But I will point out that, again, the long end of the yield curve remains elevated because of some of the inflationary concerns that I've talked about. Next slide, please. So I want to talk a little bit now about spreads, and we'll start with fixed rate spreads. The key takeaway here is that spreads remain very stable. We did see a little bit of an increase around Liberation Day, and that was back in May of 2025. But that's since spreads have since come down. Next slide, please. Looking now at floating rate bonds and specifically SOFR, since that's the bulk of issuance. Again, we saw spreads move up slightly during Liberation Day. Since then, they've trended down for the most part. In recent weeks, we have seen those spreads increase slightly, and that relates back to when I was talking about the increased issuance of T-bills, as well as Federal Home Loan Bank issuance has increased. That's put a little bit of pressure on the system's SOFR spreads. But we do expect those spreads to eventually trend back down. They might be a little less stable going forward than what we've seen in recent months. But there's still healthy demand for our floating rate debt. Next slide, please. So this slide outlines the days of liquidity that each of the system banks hold. And I used June 2025. That was the date from my last funding update in October. And then the most recent numbers we have, March of 2026. So I think the key takeaway here is that in terms of overall liquidity, as well as the highest forms of liquidity, which you'll see there in the blue, the system remains well above regulatory minimums. I will note that the Farm Credit Bank of Texas did see a little bit of a decline there, and that's just largely due to balance sheet shifts, which resulted in their investment portfolio declining slightly, but still well above regulatory minimums. Next slide, please. So I wanted to touch on a few things that we're monitoring as we move through the rest of 2026. And the first is the Federal Reserve. We have a new Fed chair, Kevin Warsh. I think there will be a period of adjustment for market participants, given that he has a particular style. He's not an advocate of forward guidance. That's something that the market has come to expect. So I think in terms of how markets react to that change in forward guidance, that could lead to some volatility in bond markets, which to some extent we're already seeing a little bit of. And then in terms of inflationary trends, I've talked a lot about inflation in this presentation, but just want to emphasize that obviously the path of inflation will impact the Fed's decisions on rate cuts or hikes, and in turn that impacts system debt pricing. There's still a lot of uncertainty around which way inflation will move. So during the June meeting, 9 out of the 18 Federal Open Market Committee members who submitted forecasts thought that rates will be higher at the end of 2026. And they sort of varied on how much higher they thought those rates would be, but there's still a lot of uncertainty because the trajectory of inflation could shift. I did talk about the US-Iran conflict. That continues to be in the news, and depending on what's happening with peace talks, that can impact the U.S. Treasury yields. We're also seeing, the tariff impact, I think, has largely worked its way through the economy, but there could be continued impacts from that. And then something else, I was reading through the Fed Open Market Committee minutes yesterday, and they mentioned sort of the impact from AI spend and all the spending around AI infrastructure and investments and how that could potentially continue to put upward pressure on inflation throughout the rest of 2026. In terms of global conflicts, so last time around I talked about Ukraine, Middle East. Obviously the US-Iran conflict remains front and center. And these conflicts can impact commodity markets, so including agricultural commodities, but also the farm economy in general. So through things such as input prices, like fertilizer, fuel costs, transportation, bottlenecks. But I think the other point is that these conflicts can lead to volatility in the bond markets. And that's something, again, that we've definitely seen play out in recent months. And I think one of the impacts there, and I didn't talk about this on the slides, but in terms of callable debt, we did see some volatility in those spreads, more so than in the floating rate and bullets, just because callable debt tends to be more sensitive to market volatility. But that's definitely come in recently. I think back in March, we saw a lot more of that. So those are just some of the things that, we'll continue to monitor going forward. Next slide, please. So just some of the key takeaways. Overall, demand remains very strong for system debt, despite the volatility that we have seen. I talked about the normalization of the yield curve, but the fact that the long end still remains somewhat elevated. Risk premiums, again, remain favorable. We'll continue to monitor the SOFR floaters, but again, they're still quite favorable. And then the secondary liquidity is ample and well above regulatory minimums. And then I touched on the wild cards that we'll continue to keep an eye on as we head forward. And that concludes my prepared remarks. So I'll stop to see if there are any questions.
Thank you. Questions?
Yeah, Shara, I'd like to maybe go back to slide 16 on my question, if they can flip back to that. And my question is, I commented yesterday, it's always good to see those narrow spreads. In the FCA meeting, I think they said that it's as narrow as it's been since in 20 years. And that is a regulatory agency I believe that's a good endorsement for our job in maintaining that good reputation for safety and soundness. On slide 16, we've consistently maintained about a quarter of the GSE market with good demand continuing. The other GSEs, is there a reason? Do we have a more favorable spread than the others? How do we compare with the other GSEs?
So I do look at what the FHLB issuance is,
Right,
because that's
yes.
sort of who we compete with. I also look at Fannie and Freddie, but I'd say our spreads are fairly comparable.
Okay.
And I know the Funding Corp, they do monitor spreads against specifically the FHLBs to ensure that they're staying somewhat comparable. So maybe 5 basis points difference depending on market conditions, but
yeah,
they do track pretty closely.
Okay. So we don't necessarily have a competitive advantage there,
We have a
or
different
maintain a
mission,
competitor, just a
so
good.
I think that could be an advantage depending on what's happening with farm credit versus
Well, again, it's good to see that consistency over 5 years. That market share is there. Okay, well, thank you. And thank you, Mr. Chairman.
You're welcome. I'll kind of follow up on that. I was at the Ag First Annual Meeting last week, and Tracy McCabe with the Funding Corp did have a chart that compared farm credit system debt and our spreads to other financial regulators and other GSEs and then other corporate bonds. And she showed that farm system debt had the narrowest spreads of any one she had on the chart. Now, I'm not sure how inclusive her chart was, but of the chart she had, it was just really tight with treasuries. And
Good.
just sort of kind of picking up on that, then what's the significance to that? The significance rolls down to the producers. That tight spread gives them lower cost of debt.
Yep.
And I still think it makes a big difference in the sort of setting a competitive benchmark with other lenders in the system.
Out in the
So
industry.
it just all feeds back to supporting agriculture in a way. And I agree with you. I think having a good regulator, brag on ourselves a little bit, makes a little bit of difference too. And the confidence and the reputation of the farm credit system is really sometimes just the key that we really have to kind of look at to maintain.
And setting the market, you're exactly right. With banks, usually the first question they ask when you're shopping interest rates is, what's farm credit doing?
Right. Yeah.
So,
Yeah, and we might see the overall level of prices increase of the yield, but to your point, our spreads, the system spreads remain very, very tight.
Yeah. I don't have anything else. Very good presentation, Shara. I think this is, I think it's valuable to understand how all this fits together. The Farm Credit System, Funding Corporation system, and what we do as a regulator. I think you bring out all those good points. So thanks for your presentation.
Thank you.
Well, if there are no further questions, we're going to move to the adjournment tab. And if there's no further business to bring before the board, I'll entertain a motion to adjourn the meeting.
Mr. Chairman, I move that we adjourn the meeting.
I second the motion. Motion's been made and seconded. Any further questions? Not, Secretary, call the roll.
Mr. Smith?
Aye.
Chairman Hall?
Aye. Motion carries. Meeting is adjourned.